Okay, let's take a look at the 20 period exponential moving average on the weekly chart of the S&P 500. I just want to show you that moving averages can be used across a wide range of markets. Doesn't matter. If you can trade it, you can apply a moving average to it. Okay, we can see starting out that the moving average acted as resistance. Market pulled away from the moving average and snapped back to retest it, and then briefly traded above it, then pulled back to retest it, moved a little higher, then retested it again. A market like this, a sort of choppy range bound market, a moving average will tend to give a lot of signals and whipsaw you in and out of trades. So moving averages are most useful in trending markets. There are other indicators such as stochastic oscillator, which is more useful for a flat or a sideways bound market, but moving averages tend to work best in trending markets such as this one, and this downtrend here and this uptrend here. We can see in this downtrend, price moved into a downtrend, making a series of lower highs and lower lows. It came up to retest it. Moving average acted as resistance. Price moved down and snapped back to retest it again. Nearly touched it, and then price moved down again, snapped back to retest it again. Here, market was a little choppy, little range bound for a while, and sort of went sideways and created a lot of whipsawing signals that would have had you whipsawing in and out of trades. If you hadn't identified that the market was moving sideways and wasn't trending, you were relying on moving averages, this would have been a pretty tough time, I imagine. For others, it would have been a great time and they would have made a lot of money. But for if you're a trend follower, markets like this are tough to trade. Price moved down, made the penultimate sort of low in March 03, just before the second Gulf War, then moved up. Moved above the moving average, sort of retested it with this big fat tail here. Bounced off it as support, sort of bounced off it here, came close to touching it here. Price moved up, snapped back to retest it. Price took off again, snapped back to retest it. Price took off again, snapped back to retest it. Big fat tail here. And then the market got a little sort of choppy, a little range bound again. For 2004, the market was in the lead up to the presidential elections. The market was in a minor downtrend, and you can see here it made a lower high, lower low, lower high, lower low, and it was a trend in a trend channel, downwards trend channel. I'll just draw it in here for you if you like. There you go. Okay, price then made a higher low, broke the previous high of March of that year, and then took off again into what you could term another uptrend. Price moved convincingly above the moving average, got a little too far away from it, and snapped back to retest it once again. Price then bounced off the 20 period again, and then retested it and broke through it. And then it took off, pulled back to retest it again, and so on and so forth. And you can see time and time again, price gravitates to the 20 period moving average. It is gives wonderful signals. We can see now on the weekly that price is crossed beneath it and is looking to retest it again. So, will it act as resistance? Who knows? Time will tell. Okay, let's also take a look at the Nasdaq and see how effective the 20 period exponential was there. Okay, you can see when the market was in a downtrend, price pulled away and snapped back to retest it, moved above it, snapped back to retest it, moved beneath it, snapped back, and this time it acted as supportive resistance. And in this downtrend, every time price touched it, it would act as resistance. It couldn't get past the moving average. It was like a moving brick wall above price, and then it pulled away from the moving average and snapped back to retest it, acted as resistance, pulled away from the moving average, snapped back to retest it, acted as resistance, pulled away from the moving average, smacked back, retested it, busted through it, pulled back, acted as support, market got a little choppy round here, then market then moves into an uptrend, and then price pulls away, snaps back to retest it, price pulls away, snaps back to retest it, moves into a range, and you can see time and time again that these things tend to work a treat. Let's all take a look at the Nikkei 20 period moving average. Okay, you can see here the market's in a downtrend. Price rallies up, acts as resistant. Price pulls away, snaps back to retest it, moves up, moves through it. So this indicator isn't foolproof. It doesn't work all the time. nothing in technical analysis does. It's technical analysis is a lot like playing blackjack or poker. It's about getting the odds in your favour. It's about position sizing and betting.